Right, so guys, I will be back with you imminently. I'm just putting up something which is relevant to a discussion that we were having yesterday. So give me a moment on this. There we go. Okay. Right, this is where we were yesterday. I was talking about this whole idea of considering the pound over the euro and where exactly we could go with each. That was the idea yesterday, that if you can get over these 126.13s, then we can move up through the range. The euro, a little bit messier. What's happened today then, and this is a trade we were just talking about here, so I'll explain the idea of the trade in a little bit more detail. What's happened today then is the pound has broken higher. It's broken through 26.29. You're looking up towards 26.96. At the same time, this has now finally taken the euro with it as well. Now, we were just talking about this as a trade. I tried to get onto this trade. The pound had already started to go. So this is then one where you look around and go, well, what's actually the best choice here? You know, what's your dominant trade? You can chase the pound up all you want, but do you really want to be chasing the pound and buying it somewhere up here? Sorry. Yeah, buying the pound somewhere up here, or in the euro, that equivalent of kind of halfway up this candle is breaking the highs from yesterday. So the pound's on its way into some open space. It's clearly got some strength in it. The euro is now starting to go as well. So whilst I said that the pound was the preferred trade yesterday, if you're not on that, you then got to look around and go, well, where else could I take this trade? What else could I do about it? Make sure you've always got options. You're always kind of considering where you could take the trade rather than kind of just thinking, oh, I seem to have gone. It's got away from me. So what had happened in the euro, we'd skipped up after the data, little flick back. That gave the chance to buy 57 with a view now that I've got a little area of resistance here, 05.90, and then really this would be my main sort of target, 06, 08, 05, 7, whoops, this kind of area up here. So you're kind of watching, see how it gets there. Incidentally, just show you on the ladder what it is doing at the moment. That's where we are, so long down for 57. What we're starting to see is this accumulation of volume at this point. So whilst I said that I've got a level at 90, the fact that it's starting to build volume here, to try and reduce position slightly, just cover a bit, I'm going to go towards the top of this area just to try and reduce the position, then leave another part of it to go onwards, upwards towards the 06, 07 area. So you see it nearly got filled. Incidentally, that euro ladder is tick compressed. So it's taken the half ticks out of it because half ticks are really annoying. Well, that's my view on it at least. So that's the way that I'm looking to try and take that on. At the minute as well, based on where we are, I don't really think there's a great deal of reason to move your stop up, apart from it still being down here. You could make an argument if you want to be tight that you could go below this sort of intermediate high, which, I can't think exactly what level that would be, probably around about 60 or 62, 63. But then once you're coming down there, whoops, oh damn, I accidentally sold one. No, this is just a demo to try and just sort of illustrate the trade, so I can just do it on multiple different things to illustrate trades. But we've got one out now accidentally, so that's that one. But if you're coming all the way back down towards 62, 63, you might as well keep your stop lower down and sort of say to yourself, well, if it's going to come down here, I'm playing for that anyway. So it's almost the case of, if you're really nervous about this trade right now, then just give it up here. I think if you give it up here, you're giving it up too early, really. You go and look at the pound. Where's the pound got to? At the minute, the pound is, so I'm just trying to see on my chart, 26.64. So it's still around about here. The pound's still got a fair bit of space to go. It's got another 30 ticks to go in it. So for the euro to do equally another 20, 30 ticks seems quite reasonable. That'd be the way to be looking at that. So I wouldn't want to be running for the exits when you're 6 ticks on side. When you're 6 ticks on side looking for a 50 tick move. Right. So there we go. Be interested to know how everyone's got on with the exercise. As far as I can see so far, nobody's done anything apart from Peter. So well played on that, Peter. But otherwise, there has been very little else by way of results. So we'll come back to results in just a bit. So if you have got any results, it'd be great to hear how much anybody has managed to lose, and also what you've learned from it, what you've taken from it. The whole idea of this was to give you guys a bit of a challenge, but also to in making it a game, then it becomes more don't want to call it fun, but you take the kind of reins off. You know, you're kind of generally taught to try not to lose. You know, that's a general objective, to try not to lose. When you're allowed to lose, it's more acceptable to you. So then the reins are taken off, because if you go up and you go positive, well, that's always a good thing, right? So it's always a good thing to be positive. But if you lose, now you're winning the game. So in both situations, there's not a huge amount of downside in either scenario. Whereas when you're trying to make money, losing money is seen as a particularly negative thing. This is then harder to deal with, in which case you then restrict your upside so that you alleviate losing money. Quite the answer there, Darius. I'll try and explain, or I'll try and summarize that in a little bit. Right, we'll come back to that point. So that was kind of the idea around it. We'll come on to, I'll leave people to sort of get in how much they managed to make or lose. So far as I can see, Peter was winning with minus 6,100. Darius seems to have taken the lead with a minus 11,000. Although there was a trade at the beginning that kind of went wrong, which created that a little bit. I'll explain this because there's a few things here. I got a message sent in about a trade and Jigsaw kind of went down, and also how do you deal with this? Now there's a couple of things here. Without wanting to be harsh, this is partly your own fault, and I'll explain that in just a moment. But let's just go and discuss what's actually gone on. So NASDAQ whipsaws in the phrasing here, about 70 points in 5 seconds. That move there on Bookmap. So we've got that quick whip up and down. So clicked flat key, but that failed. Tried to close it with market order buttons, that didn't work, and then eventually hit the DOM. First thing here, wrong order, click the DOM first. At least then you know where you've clicked and what you think you've done. If you click on any other key, that key, take a flat key, right? So the idea of flat, what that's got to do is it's got to look at what your position is, define what your position is, change then your next clip, and then click it, and cancel all orders. Whilst that is well within the capability of any kind of basics computer software, it is a chain of things that can go wrong. And it's also a chain of things that need to happen. In a period of very high volatility, there's a ton of information getting forced through that trading system. This is then going to slow down actions like that, because it's also processing a ton of other information. Go ladder first. It's one click, buy or sell, whichever it is. So that would be the first thing. Also, the flat key, the market order key, you are taking away all your own self-control. If you click on the DOM and you click the price you want, you've determined the price that you're willing to pay, right? If you use the flat key and the sequence of actions go too slow or too quick, whichever, you run the risk of it hitting you wherever. So what I mean by that, let's say you're long here, irrespective of whether you try and make or lose money, you're long, you click flat. By the time it has taken all that information in, along with the mountain of other information that's going in at that point in time, go click, 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 it sells there. That's a real extreme example, and don't get me wrong, it's not going to take 5 seconds. But you have no control over that. At least if you're looking at the ladder and you click sell there, you know the price you clicked at. And if the market was trading there when you clicked, theoretically you should actually get that order executed. Even if it doesn't show it instantly, you can assume that that has been executed. If you just click flat, you don't know what price that was trying to click you at, so you have no real idea of where you've been executed on that. That would be the first thing. So don't use those buttons. You don't need them. You've got a mouse and you should be looking at the ladder anyway, so don't use those buttons. The other thing as well, and because the question was then, well, how do professional traders deal with this kind of stuff? First thing, make sure you've got TraderBait on from the start. Because if you get any fault on Jigsaw, and this is the case, unless your execution software is direct to exchange, it does not have a news feed inputting into it, a data feed inputting to it, so something like CQG or TT or Stellar, if it's not one of those, you need the origin source of the data open, Rhythmic, Trader8, whatever it is. So make sure you've got that open. That's one of the other things. Yeah, there's stuff that can be done here to protect yourself. Make sure you are doing that. Similar things have happened on other things. Yeah, I think this does happen, particularly where you are pushing data from one source to another. You know, at the end of the day, Jigsaw is just purely visualizing the data gets pushed to it. Now, if Trader8 pushes an absolute mountain of data to Jigsaw, it may not be able to visualize that quick enough. And in doing that, it delays the action of other things that happen. So as it tries to catch up on backlog of information being pushed to it, orders that are then being clicked in reaction to that then get sent back to Trader8, there's a huge backlog of information that has to go through. That's where you can get some of these delays. It's not just you who runs into glitches like this, and whilst I've said to you, it's when you have other data sources, TT's not infallible, neither is CQG or any of the others. So you will get it, and unfortunately, these things typically happen around times of significant volatility, simply because of the amount of data that's getting pushed towards the platforms. Difficult being unable to close on a move like this is going to immediately reverse, really frustrating, would have been a terrible result on a live account. Just remember this, that would be a terrible result on a live account. The reason that this would be a terrible result on a live account is because you've carried a position, which is also then relating to this. Notice that while I'm looking at the picture, orders, presumably all the algo orders, were pulled just before the liquidation stop hunt, or whatever one would call it, to the upside on NASDAQ and both sides on the S&P. I'm curious to go back through similar types of moves and see whether that can actually be correlated. It's completely correlated, and this again comes down to the reason that you would have a terrible time on a live account, and you will not mitigate this on a live account. That was the data point. Rich from Fed, consumer confidence. You have to be aware of these types of things. This is why I say, you know, part of this is ultimately your own fault. The reason that all the liquidity pulled is because you have a data point and it's not going to sit there to get run over on the data. That's why you get these bigger moves. So it is a situation that, yes, there are, of course, I can understand the frustrations of not being able to execute, but you also should never put yourself into that situation. You've got to know that the data's coming out. And if you don't, whilst, yes, the platform didn't stand up to the scrutiny of the volatility, ultimately you never needed to be part of that anyway. So that's just what, the one thing that I would suggest you really need to remember. Coming on to the question of professional traders must have some way of dealing with this to not be locked in when they want to get out. I'm just wondering what exactly that is. Well, like I say, firstly, it comes down to not holding positions into data unless you are very clear what the trade is and where your stop is and have your stop placed. That's the first thing. Ultimately, there isn't a great deal you can do, and this is one of the things you have to, from a psychology perspective, be able to accept that there are risks in trading that you can control. So try and think about what is controllable and what's not. You ultimately can't control whether your platform goes down. You can have a solution. The solution is be able to call your broker. That's really the straightforward solution. So everyone's got a number for a broker on their desks. If anything like this happens, you get on the phone and you say, get me out of whatever, or sell me whatever, buy me whatever. Straightforward. This is very much the same as making sure that you have Trader8 open when you're clicking on Jigsaw, so that if the orders don't seem to go through, you go over to Trader8 and go click on there. Ultimately, what it shows on Trader8, remembering that this is effectively your broker, that's the true position. So if Trader8 and Jigsaw don't match up, trust Trader8, trust wherever the data comes from. So I know that sounds a little bit harsh, like me telling people off, but make sure you deal with the things you can deal with. Don't hold stuff into data points. Make sure you've got your broker feed turned on and easy to access, and don't use buttons that give you no personal control over the execution of trades. That would be the three sort of key things there. Like I say, from our perspective, the other thing is being able to have a phone number of your broker on hand, so you can just answer that immediately, or not answer it, call it immediately. That is then how you're going to get the result, or how you're going to be able to mitigate it. Some things you just can't do anything about, unfortunately. It happened to well, all of us. February this year, CPI data, TT went down on it, and some people were in positions, some people weren't sure if they were in or not because they clicked. So, and then it goes down, so you don't know if your order was filled or it wasn't filled. You have to, one of the other things on that is you just got to keep a cool head, right? You got to keep a cool head and think, right, what have I clicked? What prices, what market? You should know those things instantly off the top of your head anyway. It shouldn't require any thought or going through logs or anything. You just know. If you don't know, you've got to ask yourself, why were you clicking there? So you know that. Make sure that you got that in your head and call somebody. And that's ultimately how we solve these types of problems. Yes, it helps that if you're in a firm, a prop firm, we're also watching risk. So we can see that things have gone down and we know that people are going to want to be trying to get out positions. You're going to look and go, right, that trader, that trader, that trader, that trader in positions, we need to do something with it. But it's about having a clear kind of, in your head, what are you going to do in a situation like this? Take this as a good learning experience. Ultimately, this did not cost you anything in real money, so don't worry about it, for one. But make sure that, like you say, this would be a shocker if it was real money. And ultimately, a lot of it is a thing that you could have mitigated anyway. The platform going down, Jigsaw not displaying the information, you can't mitigate that. But there were other things that you could do that would deal with that problem. That's the way you've got to try and look at this type of thing. And also be honest with yourself here. If that had turned out that you ended up with a winner on it, would you have been too bothered about it? And that's not a good thing if you would have been not bothered. But I know that there's an element that a lot of people go, oh, I'll go away with that, good, and don't really think anything more about it. But the fact that this went wrong is a good lesson that you need to make sure that you have thought through how you're going to deal with a situation like this in future so that you can deal with it. Right. Oops. Okay, we're going to have a look. A couple of them that came in. Joe, you made any money? Lost any money?
No, I was wondering what you said that you lose $1 million this morning. I forgot about the exercise.
You've got to stay on the ball. That's one of the other key parts of this. Stay on the ball, remember what you're trying to do. Okay. Right. Well done, Peter. Lost 6,100. Hopefully. Hopefully you didn't go too far up to achieve that, and also hopefully this is a larger loss than anything you've achieved on the upside so far during the course. But job done. 6,100 is pretty decent result. Most people short NASDAQ at the double bottom in pre-market, so I'm going to assume down here. Tried some chopping long short, but ended up with mixed results. Went short at the low on the premise of yesterday's rotational price action, and that no one wants to sell the indexes on the day before Thanksgiving and left as a negative news catalyst. 3 things I've reflected upon. We'll come to those. Yeah, I tend to agree that on a non-directional day, unless this has anything dramatic about it on the downside, you've probably got a good chance of losing money selling into lows on what is a relatively quiet day as well. One of the ways to have done this, or to achieved, particularly if you're doing it today, a negative performance, is to think about the situation that you're in. Think about the environment. This is the day before a US holiday. It is not likely to be a particularly directional high volume day. In that case, things that don't work well on non-directional low volume days, selling into lows and buying into highs. Trying to play breakouts are not really the thing to be doing on these types of days. Granted, if you've got a really clear structure, the dollar, for example, then it would make sense to play a breakout. But things like equities that, yeah, absolutely, yesterday told you they have zero interest in going anywhere, and unless they start off and become quite directional quite quickly in the overnight, are also telling you that they have very little interest in going anywhere. So it makes a lot of sense. You're playing into your strengths, so your understanding of what's going on here. There isn't anything going on, so why go selling into lows unless you're trying to lose money? Sensible way of looking at it. I thought this was a really good insight and well sort of articulated. It's no easier to deliberately lose money at random than it is to win it. Completely agree with that. Markets ultimately are random. There's no way of defining precisely what they're going to do at any point in time. It's an extremely difficult thing to know what's going to happen next, any better than about 50-50. What you can do though, and because what you're trying to do when you're trading is not what's going to happen next. It's whether you are going to move from this point to this point before you do something else. So you're trying to define a sort of structure of things that are going to happen. If you can do that, then that can become a little bit more predictable. Equally, when you get into a trade and it starts to progress towards whatever the scenario is, that gives you more clarity. And when you're having more clarity, this is where you can push size. So that way, what you're doing is you're taking a pretty random result or random likelihood of result, waiting until the result starts to become clear and then adding on to it. That way you get paid when you're right and you don't lose so much when you're wrong. But what you're trying to do is, not get sucked into the randomness of what's going on, because the randomness is the thing that you're not going to be able to compete with. In the same way that there are some things that will happen in the course of your trading career that you can't do anything about. And randomness in markets is one of those things. Trying to be successful by trading and watching a negative P&L has the same outcome as trying to positively trade it to win. I'm going to assume the take on that is that the more time you spend looking at the P&L, the less you actually achieve in terms of actually trying to get a bigger loss is not aided by looking at the size of your current loss, because you're always stuck into this idea of, well, I've achieved this much now, I better try and hold on to that. Incidentally, the Nasdaq's just gone and broken that low, not by a great deal, but it has whizzed through that little low. So that would be my sort of take on that one. The absence of a plan leads to random results when trying to lose money. Yeah, completely agree. So, and I hope that other people have discovered this. Part of the, yeah, good. I'm glad I interpreted the same as the way Peter meant it to be. I completely agree with this. And part of the reason for doing this and giving you guys this as a challenge, if nothing else, is by aiming to lose money, you may teach yourself that some of the things that you think lose money don't. For example, just clicking randomly has no better chance of losing as it does winning. So what that also helps you with is the idea that there has to be some thought process into what you're doing, because if you think that clicking randomly will lose, that would imply that it will also win. Or sorry, if you don't go random, you'll win, and that doesn't entirely work. Randomness will just produce random results. That's all that will happen. So that's really, really important to try and understand. There's got to be some clarity of what you're trying to do in order to lose money as much as there is to try and make money. Interesting, this principle endowed ownership and prospect theory apply as much to losing money when that is the game as it does to winning money under usual circumstances. I think if that is the case, that is wonderful. On the basis that if you can view it like this, this would also imply that you can see making money almost as a game as well. At least that's my kind of interpretation of it. And so if that is the case, then it should make your life relatively easy to try and lose money, or try and make money is more to the point. Personally, I've always felt that when it becomes a game, there's less downside to it, which makes it easier to perform on, which I was hoping people also, one of the other things that I really wanted people to be able to take from this is most people will manage to lose more than they've managed to make on any day. And what that serves the purpose of illustrating is you can do it, you can achieve those levels, you can achieve those numbers, and really it's your own self that's been restricting you. You have to also balance that against how much risk were you taking to achieve these things. Because one of the other strategies people go with is, well, I'm just going to max size everything and then turn up with some wonderful results. And again, increasing your size won't make you lose money. Increasing your size will just accentuate whatever you do manage to achieve, making or losing. But part of the idea here is that when it becomes a game, people are more willing to use size, which you should bring into your trading anyway. If there's a situation where you think, yes, this is definitely going to lose, and you're willing to lump the size on it, why wouldn't you do the same when it's going to win? Because that's the whole, that's ultimately what is the difference between people who might just about be able to make money, or at least scrape along, and people who actually make serious money, is the fact that they distinguish, particularly with the use of size, a trade that they think is, possibly all right, and a trade that they think is really good. you've got to take the ones that are all right, because some of those will start to become or start to look like, yeah, this is really good, and you add on to it. But a lot of trades when you first enter have all got relatively similar kind of criteria or expectations. You think, yeah, this is good. You wouldn't take it on if it didn't. But when you take it on, after you've been in the trade a little while and you start to see the way the market's moving, you start to understand whether it is or isn't good. If it doesn't look good, well, you can keep your stop and you take the loss, or you can just get out. If it starts to look good, you can add to it. And now you're in a situation where you've got a trade that not only did you think was looking all right to start with, it now definitely looks good. Get the size on and you get paid on those. If it starts to look good, chances are that's because the odds are tipping in your favor, which is also something from prospect theory, that often as a trade starts to look good, rather than, and this is something you will really need to try and remember, and always try and think of it as you've got to step out of your comfort zone, particularly when the traders allowed it. What people do is they're very quick to go, that's a relief. I don't need to worry so much anymore. I'm on side, I'm feeling comfortable, I'm just going to let it go. And you feel relaxed. You're not supposed to be stressed in every trade. You don't want to be in every trade sort of panicking, sweating at your screen. But there's also an element that if you are in a trade and you feel completely at ease with it, you have to question, are you doing this with enough size? There should be an element of, you've got to sort of think of it, when you're in a trade and it starts to look good, there should be a desire to get more into this trade, a desire to kind of push that, rather than it be a situation where you're kind of pleased with the result of it and you're kind of pleased that you now don't have to worry too much. If you don't want to worry, just put your money in the bank, buy some government bonds or something. You'll get a return, you'll get your money back, you don't have to worry about it. But you should be trying to push it. But from a prospect theory thing, or a prospect theory idea, what happens is if you have a trade where this is the, I'm just trying to draw the example of it. That's your potential payout, and you've then got the probability of the payout. Now, the probability of the payout is directly related to the payout, theoretically. The closer you get to this point, the more and more likely it is that you will get to that point. It becomes self-fulfilling. What people don't do very well is, as you get towards this point, they will then go, okay, the probabilities of me getting here are going up and up and up and up and up. Rather than look at this as a reason to add to the trade, because things are looking better and better and better for you. Yes, the payout will be less because you've already gone up this many ticks, but the probability of that much more is very, very, very high now. What people do instead is they will take a payout that's like that. They'll be happier to give the trade up, despite the fact that the probability of this going wrong is getting vanishingly small, and they want certainty. So they're willing effectively to pay a very high price for certainty, that you're basically willing to lose this much on a 10% chance that you don't make that much. So you're giving up a very large amount. This is the same kind of principle with that kind of idea of relief in a trade, that if you're in a situation where you're feeling relieved, well, probably that comes from the fact that you're now very confident this is going to work. If you're confident this is going to work, you have to kind of flip that over and try and recognize that idea of, oh, I feel quite good, this is probably going to work, and look at it from the point of view of, this is a good reason to add some more to the trade. I'm increasingly right, add on to the trade. See, I'm quite a big fan of that sort of prospect theory idea. I did the bit on it of basically a similar type graph like that, and people's willingness to take risk. People's willingness to take risk increases way before the amount of payout, i.e. things that are going to cost you very little if they go wrong, but offer a reasonably big payout, people are willing to take a disproportionate risk on, i.e. the probability of this is not particularly high of working, but people are still willing to do it because the payout is potentially there, but the probability of getting paid is very low. When you're in a situation with a very high probability of getting paid, people generally don't actually get paid for it, and they will optionally choose to take less rather than more. I don't know if any of you had a think about the radio question that I put up on the psychology bit. It was a good example of that type of idea. Similar concepts of lottery tickets as well. People are very keen to buy lottery tickets because the cost of the loss is very little and the payout is potentially massive. But the actual, when you balance the probabilities of those two things, a lottery ticket relative to the probability of winning the lottery is actually extremely expensive. A lottery ticket in the UK should, to make it just about worth buying, that you would have an even chance, it should be about 30p, and you're paying £2. So you're way overpaying for it. You're paying 6 times over the money for something, but people don't look at it like that because it's only £2. If it was £2,000 and the top prize on the lottery was 3 billion, people wouldn't take the trade on because the cost of the initial outlay, despite the fact that the ratio of payout is exactly the same, the prospect of losing that much money would put you off. So things shift as the numbers increase. The radio show game that I referenced was it was on the radio about 2 years ago, and what they did is every week they got someone on, you answered some questions. If you got the questions right, you were offered a prize, about £5,000, or the chance to be in a draw for £1 million, and you had to choose which you'd pick. And the whole concept around that is, well, one of the questions I sort of posed on the video was around what information would you need to know to make a decision on that, which ultimately comes down to the number of weeks they're going to run it for. They're running it for 25 weeks. So the simple way you work that out is you go 1 million divided by 25, because you've got a 1 in 25 chance, is 40,000. So if you're offered anything less than 40,000, you should go into the draw. Prospect theory works differently though. Theoretically, you should go into the draw for anything less than 40,000, because the only way someone should be able to buy that ticket off you is if they're offering you more than that. You've effectively got a £40,000 ticket and they're offering you £5,000 to give it up. You shouldn't give it up. So you look at it like that, it doesn't make sense. But prospect theory works on the basis that the prospect of losing £5,000 immediately, because you could take it, is a far worse feeling than the possibility of maybe not winning $1 million in future. So that's the whole sort of concept around it. That relates quite well to trading. The possibility of losing, despite the fact that the chance of you losing is getting vanishingly small, outweighs the extra money you're going to get by staying in that trade, and also justifies why you don't add on to a position. So whenever you get that sense of sort of, oh, I'm feeling a bit comfortable on this trade, it's all looking all right, you're probably better to go, yeah, well, let's make it not feel so comfortable and actually go for it a bit. Right. Very detailed explanation. I will try and sort of paraphrase. 2 good technical losing trades in oil and gasoline. Gasoline, of all the volatile things to trade, no pun intended, is next level volatile. Gasoline trades in 1/100th of a cent. So whilst oil trades dollars and cents, gasoline trades in dollars, cents and hundredths. So there's 1,000 ticks in a dollar. It's enormous, some of the moves that you get in gasoline. Like gold does some big moves, gasoline's next level. It's cheap. It's only $4.20 a tick. You off, Joe?
Oh, it's good. I've got a copy for it.
Okay, mate. It's cheap, but it's very illiquid. Again, no pun intended. And it is exceptionally volatile. I would just generally stay away from gasoline. As much as I do intend on trading gasoline at some point, it's always been a market I wanted to put a trade on. As a day-to-day thing, because it is so thin, it doesn't flow very much. It's not really a market you really want to be trading. Holding full size NASDAQ and S&P. So that's the classic strategy of how to lose, waiting for a larger drop, but unsure whether yesterday would be that day. It wasn't. I let it draw up to an extent, expecting the upside would be limited, but at least I had a chance of a really large losing day. I was basically taking a very high risk reward trade on max size. So you've got to look at that and ask yourself, well, you're taking, when you take, say, a high risk reward, I'm going to assume high size payout, small risk on max size. You've got to look at that and say, well, if that makes sense, you should be doing that anyway, the other way around. So you've got the capability to do it. Personally, I'm not sure why you would bother doing it in NASDAQ and S&P. I understand for the purpose of this that you were trying to just maximize losses, but realistically, you'd pick one or the other. Back going into technicals, whenever I hold a trade on hope, it almost always loses, so I thought maybe this would be the same. Did eventually close it in loss, but not nearly what the move I wanted. I had to accept that it will not happen prior to our session today, so I took the loss available before it came back to profit again. Okay, this is a really good example. Whenever I hold a trade on hope, it almost always loses. That's not the case. What's happening here is an association bias. You remember the ones that you hoped and they lost. That's what happens. You remember those. You don't remember the trades that you hoped would work and they did turn into winners, because when they turn into winners, what the human brain is very good at doing is telling a story. And it turns into a winner. Ultimately, you got pretty hopeful and went, it'll probably work. Leave it. It turns into a winner, and you look back at that and you go, yeah, well, that's a great idea. Good trade. And you feel proud of yourself. So what's happening is this isn't the case. If you just put a trade on and hope, it's a complete 50-50. Like Pete said, it's completely random whether this is going to work or not. It's just the ones that do work and produce a winner, you see as being your own good idea, and the ones that don't, you blame on the hope. Ultimately, the hope is there in both. It's a mistake, and some of them you get paid on so you don't notice it. So that's one aspect of it. The other aspect of it is what will often happen on hope trades. Let's say, for example, you're selling this level, it's come up, you've sold it, it goes down, it comes back, it goes offside, and you go, I hope this comes back, and it gets a bit worse, and it gets a bit worse, and you're still hoping, but at this point, there's then, initially it's hope, and you start to hope that it's going to work, and you think, okay, it'll probably be all right. What then starts to creep in is, maybe this won't be all right, and you then start to doubt it, at which point you're now up here anyway, and so then you end up getting a situation where, rather than hoping this works, because you kind of lost all hope it's actually going to work, you're now starting to worry about how far this could go. So then it turns into a trade where you're looking at going, do you know what, this probably isn't that bad a loss, because it could be this, and you don't want that. So now it's a question of, should I just take it here, because it's not such a bad loss compared to there. It's the post-purchase rationalization, as you call it. You're justifying why this isn't that bad a loss, and then you get out and you go, that really was a bad trade. That's what happens. That's the cycle of what goes on there. The simple way to deal with this is you have a stop, and you stick to it. Also, on that, one of the ways that hope creeps into a lot of trades is because you didn't actually think about what you were trying to do with the trade. For example, I'm not suggesting this was what happened, Darius, but this is what often happens. Someone sells it there because it's good level. Like, yeah, that's a great place to sell. You sell it, it goes on side, you've got no real idea of what you're trying to achieve with this, but you think it's going down, but you have no idea where it's going down to. So then when it comes back and goes offside, you can't really justify why you're going to give it up here, because, well, you're thinking it might go down and down and down and down, and it becomes a kind of, Hollywood trade that you're thinking, well, maybe this could go through the floor. It won't, but because you've got no sort of structure around the trade, no actual plan as to where it's really going to go, you can't calculate really where your stop is or justify your stop, and you run into just hopeful trading. So it's another thing, just deal with that hope by being absolutely crystal clear on what exactly you're trying to achieve. I'm not saying that's what happened here, but what I am saying is for anybody who ever gets into these types of situations, if you click into a trade and I turn around to you and said, where's your stop and your target, and you couldn't answer within 5 seconds, it's not a trade. It's a nice idea, and that's all it is. It's like walking into a shop with £10 blindfolded. You could do whatever you want. You could trade, you could buy something. Whether that thing has got any use to you at all, you don't know. And that's the same as taking a trade without a stop and a target. It's just buying something blindfolded. So, rant over about hopeful trades. I found that I traded much lazier because it was hard to take a losing exercise quite as seriously. Somewhat indifferent to the results. That's part of the point. You want to be indifferent to the results. Results are not the thing that matters. Process matters. If you follow the process, the results will come. And if the results don't come, you need to change the process. Thought about this in terms of practical application. Usually I'm attached to the results, and it leads me to overmanage and overtrade. Although my losing trades did not all follow good trading principles, well recognized, I was generally relaxed around them and looking at the market in very simple terms, while in regular trading at times I'm not relaxed, overcomplicate views. This is the thing that I would suggest. If you take nothing else from all of this, take that. That is really, really valuable. That, overcomplicating things, over worrying about performance, P&L, any of that doesn't matter. Stick to the idea of the trade. Make sure that you've got some stops. I'd go on to write a book about what I do wrong in trading, but it's made me notice first and foremost the attitude that followed that allowed me to be so comfortable taking less trades rather than itching to do something non-stop, trying to make back losses. Yeah, making back losses as well is also one of these things that generally is not going to work very well, because you're not now trading because you believe this is a good idea. You're trading to deal with something that's already happened. I think I suggested the there's a story in a book by Josh Waitzkin called The Art of Learning, where he talks about a lady crossing road. And to very briefly explain, lady goes to cross the road. As she walks out, a cyclist hits her. She gets knocked over, she's annoyed about it. Rather than think, oh, I'm in the middle of the road and now I've fallen over, better get up and get out of the road, she gets up and shouts at the cyclist, at which point she then gets hit by a car. That's the point there, that you're not going to make back losses by trying to deal with the last loss. You're going to make back the losses by doing the right thing, get out of the road at least to start with. So hopefully that helps solidify that story. So rather than should do something, it actually allowed for a decent result with much less stress. Good results would probably come about by combining some aspects of this attitude with more technical structure, removing laziness. All easier said than done. It's easier said than done, but it's a lot easier to just be clear on what you're going to do, structured in your plans, and then just execute according to that. Sometimes I agree, it can feel lazy that you're not being as involved as it perhaps feels you should be. I think a lot of the time, trading is not about being super involved. It's about being clear on when you want to be involved. So it can feel slightly lazy. And equally, when you're in a trade, you also don't need to do a great deal. Part of the planning, part of the working out what you're going to do, being clear on what you're going to do, allows you to then go, okay, well, this is the point of execution. You execute, and then it's just a case of monitoring. You've done the work to work out where you want to be in, and why you want to be in, and what you want to do. Once you've done that, execute it and let it go and do its thing. Wait for more information to come in, and when that information does come in the form of sort of price movement, the way we react off levels, then you relate that back to your original idea and say, does this still stack up with my original idea? Is this what I would have expected to happen? If so, great, you stay in the trade, you stick with the idea. But it becomes a lot more clear, it becomes a lot easier to do, a lot more comfortable if you have that type of attitude. So, good, great result out of this. So I kind of added my own views up here, but I think you kind of answered those further down. I know that you put in 2 paragraphs, which if I'd paragraphed this up would have been a little bit easier to relate back to. But yeah, absolutely, I think you've kind of answered your own questions, and that should set you up really now to sort of see that as the way forward. That was kind of one of the big hopes or the big aims of this exercise, was to get people to kind of realise perhaps some of the mistakes that they already make, and sort of allow you, because it allows you to do those things. It allows you to make those mistakes, go, oh right, that doesn't actually produce the results that I thought it did, and shows you where you are sort of making some mistakes. Grimy keeps coming in with a question and then doesn't, and then does, and then doesn't. So I'll wait and see if he's got an answer to that. How's your Nasdaq trade worked out?
Quite good. 9,000 profit. Waiting. I mean 9,000 loss.
Yeah.
Waiting for it to drop further, but I have a zone marked on 5 minutes. If we break above, I'll get out.
So this was Emmanuel's trade. You short from somewhere up here, right?
I'm short from 29.36.
So 936. Somewhere down here. Yep, fair enough. And then looking for, where are you looking for now?
I mean, I might get out here because it doesn't look like it can go to the previous daily low.
Yeah, or down here.
Yeah. But there is a level that I marked on 5 minute, which is 806. But that's really far down, so I don't know if it will do that.
It's down there, yeah. Yeah, I can see 806, or the rejection from yesterday. It's also sort of rotated around that during an overnight as well. Yeah, I can see that. You've got through most of this sort of area from yesterday, where the sort of balance area was yesterday. And this is one where you look at where you are at the minute.
My idea is if it breaks above that wick, then I'll get out.
Yeah, I can understand that. You start getting above 0865, it runs the risk of being a bit of a reversal type move. You have it on a 1 minute. That's where you currently are. This is exactly that point where decisions, well, even decisions get made by the market here, in the sense of, is it going to keep on going? Your decision has to come down to how much are you willing to see this come back because of what you're looking for, versus how much you've actually already achieved on the trade.
Yeah, the new hour is coming as well. So.
Yeah, you've got to turn the hour. That could help you out. In fact, you've probably got less than a minute to go on that. So you'll see it in a minute. The next candle on here would be the turn of the hour. Yeah. That's where you'd want that next leg. What's interesting here, if you look at what the Nasdaq's done and compare that to what the S&P's done, which is absolutely nothing.
Yeah, S&P hasn't done it.
No. So, and that's not necessarily a problem, But-
actually shorted S&P.
Yeah.
I had S&P on the short and Nasdaq as a long to take the loss, obviously.
Yeah.
But S&P didn't move as much.
No, S&P doesn't seem to want to move at the moment, which would suggest that this has got something to do with one or two of the companies or one or two of the sectors within the Nasdaq, more so than it does with the S&P. The thing that you have to sort of stay aware of if you're short Nasdaq, or in this case long trying to lose money, is how far this can go without the S&P. You're either going to get one thing or the other. This will keep going and the S&P will fail to stay up and will then roll over. Or the S&P will stay here and the Nasdaq will go a bit and it will struggle to sustain continuation. So for anyone looking to try and play a reversal, one of the things you might look for is if the Nasdaq trades through the low and back through 39 and at the same time the S&P still is stuck in this low 30s area, it becomes an opportunity to play the Nasdaq back on the basis that there's only so far it can go without the S&P coming with it. So there you go, there's an extra level of continuation. Is that the turn of the hour candle?
Yeah.
Oh no, that was. So yeah, turn of the hour and it's starting to go. You may get that move.
I mean,
Well, that's the whole point of then you get back there and that's all about that question of, well, what are you trying to achieve with it? You know, where do you think it's going to go? If you still felt that there was another 60 odd ticks in this, then it's not really the place to get out. You've got that moving average to protect you as well.
yeah.
You could look at that and think, well, there's still scope in this. You see it now, it's starting to drag the S&P with it.
Yeah.
And that's starting to pull the S&P. It still struggles to drag
It's
it though.
struggling, that's why I'm considering to get out, but I'm just watching for now because there's no indication of reversal yet.
No, so we'll see now. Seeing as the S&P has completely failed to keep on going there,
Yeah.
you do want to play the Nasdaq. We'll see if we can play it towards the upside. Use that previous low as your entry point. What you'd be looking for is the delta to really start to jump here. If the S&P gets back into range, that's then where you're going to get that trade. If you're going for a scalp, I think you would just aim back towards 62, which would be the moving average. If you want to play this as a reversal, then you've possibly got the low and you're going up to here. And if you're short, or in your case long, trying to lose money, this is now the point where I think you have to make that decision as to whether you, whether you think there's much more in it and how much more you really think is in it.
Yeah.
You know, if you were only looking for 06, you nearly got there.
I think if it breaks above 63 or not.
Yeah. Yeah, I think where it is now, you have to look at it like that.
Yeah.
Either you had to give it up as soon as it came back through 40,
Yeah.
or you've got to give it up above 63, probably actually. You've got that little high there. Oh, that's 63 and 3/4, so yeah, 64 is probably your point to give it up at.
Yeah.
And look at it like that. Grime is still possibly coming in with a question here. It's got itself quite stuck now, the Nasdaq at this point.
I know.
Really, really stuck. It's stuck on this previous low. So it is struggling. When it bounces, it's struggling to go up. That's the only thing, that it's not, doesn't feel like...
There's not really an indication right now that it's going to break.
No, it doesn't feel like it's catching people, like people who've gone short. They're not running for the exits. It keeps trading 53 and it just goes nowhere.
Yeah.
Yeah, that's the point now. 53, 54 is where it's got to get through. If it can, then you would assume 63 is going to trade. The more and more it sticks there and sticks there, if it starts to come off, then you're back into that selling mode.
How is the footprint? I didn't check that.
No, Delta's ticking up and up and up now. So you're definitely getting people buying it. But as always with Delta, this is a case that people are buying it, but if they're not actually, if that buying is not translating into movement, all you're doing is you're getting lots of people long here at 53, 54.
But then the buyers are getting absorbed.
That's what I mean.
Yeah.
So they're going nowhere. They're going to get tired, basically. You can't keep on pushing and pushing and pushing and it go nowhere and you not get to a point where eventually you give up.
Yeah.
Yeah, it's that sort of concept of an arm wrestle, that you can't keep going forever. If the person on the other side of the arm wrestle is stronger than you, they'll just hold you until you effectively run out of steam yourself, which feels like what was going on there.
Yeah. It's deciding.
Yeah, that's it. We've had 3 minutes now where you've tried to do 53, 54, 55, and it doesn't go.
Do you think I should get out at 22, the previous low?
Well, I think if it goes back there, you're following this. So what you're seeing now in the S&P is you're seeing a sequence of, the Nasdaq, a market that it only breaks the low by a small amount and then rotates back up. So I'd at least, if it gets back towards 22, I'd look to see if it can get through it.
Okay.
If it can get through, then you're still going to have to accept that it's probably going to come back again towards the 40s,
Yeah,
but
that's fine. It's not
that's the
bad.
nature of the movement in it, that it has these big washes back before each move lower,
Yeah,
which is partly caused by the sort of indifference or the difference between NASDAQ and S&P here, that is only so far it can sort of ratchet down with the S&P still here, and then the S&P drops a little bit, NASDAQ goes again, doesn't really bounce.
yeah,
So yeah, you're in this sticky area now,
yeah,
which is always the horrible kind of waiting zone. Whenever you're on a longer duration or larger distance trade, you're trapped now between, is 40 the low? And this is what goes on in people's heads. Like, well, maybe 40 is actually the low and it's never going 22 again. But equally, and just put yourself in someone else's shoes. If you were long, you'd be sitting here going, it's not getting up, it's not going through the 50s. Do I really think this is actually going up anymore? So everyone always sees or always doubts the trade. And this is exactly what's going on here. If you're trading things like NASDAQ, one of the things you do have to do if you're long somewhere in here or short is you have to say, well, 60 and 40 are my two levels. Until it goes past one of those, you're neither right or wrong, being long or short. You are one or the other. It's the Schrodinger's cat situation. Right. Okay, I will try and answer this one. Okay, so this is a question Grimy managed to get his in. With your experience, what can help me with my analysis in the morning with the S&P to predict the direction of the bigger move in the first 30 minutes? Profile candlesticks with a pattern in first minute, the 2 or 3 days before, because my trading plan would be 3 trades in the morning from 9:30 to 11:15. 1 trade would be the big move, the other 2 would be technically according to the morning trade and the market profile reference. I think one thing I'd say on this is you're trying to be too rigid, for one. That I don't want to do 3 trades in the morning if there's nothing going on. And if there's lots going on, I would expect to do 10. So you've got to kind of, balance those types of things up, that you can't just look at, be rigid that you're going to only take 3 trades during a certain period of time. So that's the first thing. What's going to help the analysis to predict the direction? The other thing I'd say on that, you can't predict direction, certainly for the first half an hour. So I know it's really tempting, and a lot of the time the bigger moves come in the first half an hour, and that's why the attraction is there. People want to be on that first big move. You just watch the NASDAQ drop, it should have been on that. What you've got to remember as a trader is it's not necessarily about the size of the move, it's about the size that you can put on the trade. It's far easier, at least in practical terms, psychologically it's harder, but it's far easier to look at a trade with clarity once you've seen what the market wants to do for the day and put that trade on with more size than it is to actually predict what's going to happen. Prediction is, in trading, often the beginning of most failures. You don't want to try and predict. I personally don't think there's a great deal that you can predict in the first 30 minutes. What I would try and do more so, let's take the S&P because that's what's been referenced, right? I don't want to predict, but what I want to do is ask myself, at what point do I think something is going to happen, or that we are going to have some degree of clear direction? That's the way that I'm trying to look at it, right? So with the S&P here, this is a 5-minute chart. I don't need to go back miles on my profiles because that's the record high. You can see the last couple of days and we've been moving up. So you've got the general sense of direction anyway. Rather than try and predict, and this is one of the things I put in my, my 1 o'clock stream, my view is to then go, well, you're opening in range. So you've got to start from a basic framework. There needs to be a few things that you consider. We're opening in range and you're opening basically in value. You're a tick above value. So on the first point here, this is a market that already is very happy being here, in which case it's likely to trade somewhere around here. And the fact that I'm going somewhere around here implies the movement, nowhere in particular. So the first level of prediction, if you will, is that this doesn't have any particular direction at this point in time. Therefore, I don't want to be trying to participate in any particular direction. So that's the first thing. what you want to try and do, if you're trying to predict the bigger move, and I'm taking from this that what you're looking for is, can you find that one straight line move, which don't always come. What you'd have to do is go and look at all of the other previous sort of big straight line moves and ask yourself what's consistent about them. So particularly, we'll do this tomorrow. If people have trade strategies around these types of things, well, get them in. To try and find that sort of clear directional move, these sort of very straight line directional moves are probably going to have some commonalities to them. That's what you're looking for. What you have to try and do, because there are lots of them, there's with any kind of cash open, that's where all the action comes in. That's where all the volume comes in, right? So what you've got there, think of it like this. You've got this huge crowd of people that are all going to do something together. The only time it becomes clearly directional is when the whole crowd all points in the same direction. Otherwise, the crowd just runs around in a big circle. It's like a mosh pit. Think of it like that. So you're trying to make sense of the time, or you're trying to find the criteria at which point the crowd is all going to go in one way. And when that happens, you will get the clear directional move. So what you've got to go and do is look at any of these clear directional moves that you're trying to learn how to predict, and go and look for commonalities in them. Any that don't seem to really stack up, and there's different ways to do this. One way would be to go, okay, I'm going to check all of the ones that start within yesterday's value, and is there anything common about the way that they move? And this is where you then got to try and sort of filter back a little bit and go, okay, well, if we open in value in uptrending move after 3 days of value shift higher, is there something in this? If you open outside of value, if you open with a gap, try and sort of distinguish different things that are common with all of these. What you're looking to try and do is find situations where you go, right, from the off, I'm willing to go on this. Think of it a little bit like, I'm no card player, right? So I'm sure there is much better theory and explanation of this type of stuff elsewhere. But if you're playing poker, you are probably going to be aware of certain hands that if you get dealt them straight away, so pre-flop, I don't know how much you know about playing poker, I'm doing Texas Hold'em as well. So you get dealt 2 cards, there's then 3 cards shown face up after everyone has bet. You will get situations, and you should know if you play, that there are certain combinations of cards that you are going to put an outsized bet straight in. This is essentially a prediction that you can win, or that you've got the cards to win with. Similar here, what you're looking for is a situation where you go, right, if I see this is like being dealt a pair of aces, I'm going for it straight off. In a lot of circumstances, think of the number of combinations of 2 cards you could get dealt. There are going to be a lot of circumstances where you've been dealt a 4 and an 8. You're not going to go for that straight off. You need more information. So these are the ones where you go, I've got nothing. And that's the way you got to try and sort of think about it with these opens. That there's going to be a huge amount more, and this is the one thing I can predict, there will be a huge amount more opens where you don't have enough information within the first half an hour to have any idea of the clear direction. So that'd be one of the first things. I know you're looking for me to go, oh yeah, well if you look at this, this and this, that will give you the result, that will give you the answer. Unfortunately, I can't tell you that. But I would start from the point of situations that you expect would have a large directional move. So, examples of that. Gaps on the back of news, I'd look for a clear direction. Right, so on that case, Grimy, go and look at, and this is the kind of thing that you've got to try and sort of research yourself. Go and look at gaps in the market. So that would be a starting point. Go and look at every time you get a cash session gap, right? And then go and look from your cash session gap, go and look at the way that that gap got created. So you've got your cash session here. So that's your cash. And you then open here. Go and look and see if there's a distinction between the ones that do this during the overnight and what the directional move is versus ones that do that. Is there any distinction there? So that you're giving yourself some degree of criteria. Now, there's no guarantee that these are going to lead to anything conclusive, but you're trying to sort of find the situations where you go, okay, well, I'm now looking for something. Just to let you know on that, both these instances, unless this is a very, very strong piece of news, my first instinct on this is my idea is I'm looking for that as a trade, and you will know I've spoken about this type of trade before. That's one of my favorite trade ideas, right? So what you're trying to look at is to say, well, that's the clear directional move. It's only a clear directional move if this gap is sufficiently large though as well. So you've also got to then go, okay, how big has the gap got to be for me to look at this and go, one, I think it's going to reverse. Two, it's worth going for. So that's the way that I try and look at it. Another scenario that I'd be looking for is where you've got a, say, cash session. You open inside of value and this is a significant low. If you go like that through the low, particularly if you've had sort of times 3 cash sessions like this, that would be one that I'd look for a liquidation type of move. So they're the ones that I still, in this instance, wouldn't be going straight off the open, but I'd be looking for the way it trades off the open. If it trades very aggressively straight down, that would be the one that I think, yeah, this is worth a shot. Think back to 31st of October is one that I can think of immediately off the top of my head, where this low was 58.01. That'd be the one to try and have a look back at. So go and look at situations like that. So, and what I would do, this is the whole concept of creating a playbook. So a good way of starting off for tomorrow. What I would then do is try and create a, effectively a list of them. You can do it in a PowerPoint, if you really want to keep it that simple. PowerPoint, what day it was, what the idea of the trade was. So you can have one which is opens inside value above significant levels or below significant levels. Gaps created with a grinding overnight move versus a late overnight move, and go and compare all of these things. This way, what you're trying to do is you're trying to identify criteria. You go, right, I've seen this, 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 therefore I'm going to look for this, rather than it just being on any day trying to work out what the direction is, because that's always a really, really difficult thing to try and do. Because some days, you take the S&P today, just doesn't have a great deal of direction. The NASDAQ has continued to fall. We were just talking about in that 40 to 60 area. It's done it now, right? It's hit the target. Yeah. And it's gone another 66. And in the same time, the S&P has done maybe 4. The S&P does not want to go. No matter what happens at the moment, the S&P does not feel like it wants to move. Partly because you're just falling into yesterday's value. So it is naturally just going to do this sort of chop, chop, chop. So that's part of the way that you've got to look at it. This is a market that I think from the off you would have looked at and gone, I don't know where the direction of this is. Unless it goes straight for the record highs, then you can say you've got some direction and the plan would be to buy the break through the high. But if it doesn't do that, you are left almost instantly with a nothing doing type of situation. So that's the way I try and look at that. So hopefully that's giving you something to try and think about. Do it for tomorrow. For tomorrow as well, we did a bit on strategy at the beginning of the week. People who are willing to share them, get them shared. I know a couple of people already have. Get them shared, I'll stick them on the board. If you send them to me, direct message it on the portal, or you send it to my email, send them to me, I'll get them on the board, we'll go and have a look at it. What my aim here to do is not to go, that's a crap idea, don't do that, because it may not be, at least the way that, it may not be something that I would do, or a trade that I particularly like. But if there is logic to it, if there is structure, there is nothing wrong with the idea. What I mainly want to do is more sort of question some of the reasoning or some of the things that, that are the inputs. This is not to suggest that they're wrong, but just to make sure that people are clear on what exactly they are putting in and why certain information is there. That would be the way that I'd be working to try and do it. So if you've got them, throw them in there. We'll review them tomorrow. It also means that you share some, you're going to get a lot back as well. We'll do that tomorrow. The other thing, any trading related questions, throw those in and we'll cover those all tomorrow afternoon as well. Alex will be on for his final session on Friday. You should get an email on that very soon. I know he's currently, actually probably just landed now, so I can get onto him on Teams and tell him to go and get an email sent out. So you'll get a link to that. It will be on Zoom because he's in Bahamas. So that's the way that Friday will work. But yeah, trade reviews tomorrow morning, 11 o'clock, 2 o'clock. Any questions about the course, any questions about trading, anything like that, get them in and I'll cover all of those tomorrow afternoon. See you then.